Imagine receiving an inheritance, a gift meant to ease your future. Now, what if that gift came with a hidden complexity, like an individual retirement account or IRA? It is exciting, but also requires careful navigation to truly benefit from it. The tax rules for inherited individual retirement accounts are not one size fits all. They primarily depend on your relationship to the person who passed away and whether the IRA was a traditional or a Roth account. Understanding these distinctions is the first step in managing your inheritance wisely. For spouses, the rules are generally much more flexible and favorable. A surviving spouse can usually roll the inherited IRA into their own IRA, effectively treating it as their personal retirement savings. This allows them to continue deferring taxes on a traditional IRA or keep the tax-free growth on a Roth IRA and take distributions based on their own age and future needs. This spousal rollover option is a significant benefit, offering continuity in retirement planning. Non-spousal beneficiaries, however, face different and stricter rules. Under current law, most non-spousal beneficiaries, often called designated beneficiaries, are subject to what is known as the 10-year rule. This means the entire inherited IRA balance must be fully distributed and taxes paid by the end of the calendar year containing the 10th anniversary of the original account owner's death. This shorter timeline can have substantial tax implications, as it may push beneficiaries into higher tax brackets. There are important exceptions for what are called eligible designated beneficiaries. These include minor children of the deceased, disabled or chronically ill individuals, or beneficiaries who are not more than 10 years younger than the deceased. These specific beneficiaries may still be able to stretch out distributions over their own life expectancy, offering much greater flexibility in tax management. The type of IRA also significantly matters. If it is a traditional IRA, contributions were made pre-tax, so distributions are generally taxed as ordinary income to the beneficiary. If it is a Roth IRA, contributions were made with after-tax dollars, so qualified distributions are typically tax-free, but still subject to the 10-year distribution period for most non-spouses. This means even with a Roth, the money must be out of the account within 10 years, though without income tax on the distributions. To navigate these rules effectively and avoid costly mistakes, your first step should be to promptly contact the financial institution that holds the IRA. They will provide the necessary forms, beneficiary designations, and explain the specific options available to you as a beneficiary. Next, it is absolutely crucial to understand which type of beneficiary you are, as this directly dictates your options and responsibilities. For instance, determining if you qualify as an eligible designated beneficiary can open up entirely different strategies. Do not make any hasty decisions or take immediate distributions before fully understanding the tax implications and the long-term impact on your financial plan. Considering seeking personalized advice from a qualified financial advisor or tax professional is highly recommended to ensure you choose the best strategy for your individual circumstances. Historically, before the SECURE Act was passed in 2019, many non-spousal beneficiaries could utilize a stretch IRA. This allowed them to spread distributions, and therefore the tax liability, over their own lifetime, often benefiting from decades of continued tax-deferred or tax-free growth. However, this act largely eliminated the stretch option for most non-spousal designated beneficiaries, replacing it with the much shorter 10-year rule. Understanding this significant shift in legislation is key because it profoundly impacts long-term tax planning and wealth preservation for many families. Recognizing if you qualify as an eligible designated beneficiary is also a critical distinction that offers greater flexibility and potentially allows for continued stretch distributions, making it vital to confirm your status. By proactively understanding the specific tax rules for inherited individual retirement accounts based on your beneficiary status and the IRA type, you empower yourself to make informed and strategic financial decisions. This knowledge helps you effectively manage potential tax liabilities, avoid penalties, and ultimately preserve more of the inheritance for your financial well-being and future goals. It ensures the gift serves its intended purpose, enhancing your financial security rather than becoming a source of unexpected tax burdens.